The Icons of Real Estate Podcast. Are you ready to learn the proven money-making secrets from top-producing Icon agents? Ready to skyrocket your business? This podcast is for you. Tune in every week and find out how to implement proven strategies to 10 times your business. From $3 million to $30 million in just 12 months. Brought to you by the Masters in Real Estate Marketing, Arter SEO.
Welcome to the Icons of Real Estate. I'm Tim Calloway. We have a very special guest to you today, Sarry Ibrahim. He actually started a company called Thinking Like a Bank. And if you can really imagine for a minute what that means, I'm excited to hear about that because I think it'd be smart that if we all did think like a bank a little bit and quit being I'll say it, a slave to the bank. That's how I always feel. How are you today, Sarry?
Hi, Tim. Thank you so much for having me on. It's a pleasure to be here and a pleasure to speak to you in the audience today.
Yeah, I'm excited to have you here. Definitely want to hear what you have to say. So let me ask you, as a young child, as a young man, were you tugging at your dad's pants, saying, "Hey, I want to recreate how people actually use their money"? I mean, how did this all get started? Or tell me a little bit about your background.
Right. It's not really a kid's dream, right? To grow up and
right.
Start a company called Thinking Like a Bank.
Right. That's some highbrow thinking as a young man.
Yeah. The way I really kind of put all this together was being introduced to the financial services world and in the insurance world, right? So one of my first jobs while I was in grad school, I worked at Allstate Insurance, and I was in sales and marketing, and I really enjoyed it. It gave me a different perspective on talking to people, right? And kind of a different opinion of the word sales. It's kind of like almost like not so much of a liked word of the business world, right? But really, the real job I had really was the psychology of money. That's what I really was doing. I was dealing with the psychology of money, helping people really kind of think differently about certain parts of their finances. And that's kind of what I wanted to pursue. I wanted to keep going down that route of working with people and working with money and how they felt about it, because it's not just a product or service people are using. So that got me into the world of financial services. And while I was in that world of financial services, I started to do a lot of research, a lot of reading. I had to, right? Because of learning a lot of different things about financial services. And I came across a book called The Bank on Yourself Revolution by Pamela Yellen. And this book talks about, I don't know if you ever read the book, The Bank on Yourself Revolution, but it's a really good book, especially for real estate investors and business owners, because it gives you a different perspective on how money works, right? So prior to reading the book, I used to think that, it was pretty conventional, pretty standard. You have a job or you have a business, whatever leftover money you have, you put that in the stock market or an index fund or a mutual fund or with your local bank, and then they kind of do the rest. That's the way a lot of people are raised, right? With money, when you have extra money, just talk to your local financial advisor, your local bank, give them your money. They'll do their investments and things like that. But really the book uncovers like the issues with that, the amount of risk you're taking, and then the amount of leverage you're giving up by giving up all your money to banks and Wall Street. So that's where the brand Thinking Like a Bank comes in now, right? It comes in as we're thinking differently about money, thinking about how we could become our own bankers and our own sources of financing, so that when we come across real estate deals, we can finance them on our own. So high level, that's what it is. And that's where it kind of came from. It came from learning about money and how money works.
Well, that's fantastic. So what have you created? You obviously, is it a program or is it a book or is it all of the above? Kind of give me an explanatory of what people are looking at when they contact you, when they download your book.
Yeah, absolutely. So Thinking Like a Bank is an ebook, and it's the name of our podcast. So our name of our podcast is Thinking Like a Bank podcast. We brought on guests who are, all types of backgrounds: real estate investors, general partners, limited partners of real estate deals, accountants, lawyers, to talk about all types of creative financial strategies, kind of thinking differently, right, about money. That's what Thinking Like a Bank is. It's a brand, a book, and a podcast. The name of our company is Financial Asset Protection. And the reason why I called the financial asset protection is because one of the main strategies we use is a form of asset protection. So I could definitely get into more of that if you'd like.
Yeah, definitely. Just so you know, you probably didn't know this. My listeners know this. I worked on Wall Street for about 12 years. And so a lot of the things you talk about, I'm very familiar with. I used to actually train State Farm agents on how to sell and
Oh,
how to
really?
sell financial products. Yeah. So I'm with you all the way, 100%. And that's why I was so excited about having you on the show, because I do think there needs to be more information shared out there about handling things like this. So yeah, go ahead. I mean, hey, this is your show today. I'm just the DJ spinning the records. You're probably too young to know what that really means, um, but yeah, tell us all about it, man. Get in detail, because the more detail you get, I think the more people need to hear.
Yeah, definitely. And a lot of people in the real estate community know this concept is like the infinite banking concept. It's essentially the same thing, just different trademarks, right? Like I'm part of the Bank on Yourself organization with
Mhm.
Pamela Ellen's team, and the strategy we're using, it's using like a different kind of cash value whole life insurance. And your background in with insurance and financial services, I'm sure you understand like the negativity around whole life insurance, right? So it's when I say whole life insurance in the context of saving or investments, it's definitely seen as like a
Yeah.
negative. And it definitely could be, right? It could there are certain ways to structure whole life policies, like the traditional ways of structuring whole life policies are there are no cash value in them. It's just entirely expensive life insurance, very expensive
Right.
life insurance. And then over the last, I would say 20 or 30 years, there's been kind of a complete change in the way these policies are structured, using the bank on yourself concept, using the bank on yourself strategy, away for high cash value. So what that means for the audience who are not familiar with, the whole life policies have two main components or two main functions. One is life insurance in the title of it, and the other is cash value. And the cash value is like a savings portion that grows. It earns guaranteed interest. It can also earn dividends that are not guaranteed, but we only work with companies who have a proven track record of paying out these dividends. So that's essentially what it is. And somebody might be listening, why would I do that? Why would I put money into a life policy, grow the cash value? Well, there's a lot of tax benefits behind that,
A
and a
lot of
lot of
tax benefit. Yeah, for sure. That's the number one reason to me. I didn't
yeah,
mean to interrupt, sorry, but
yeah,
but it's like the tax benefits alone. I tell my
yeah,
children, I said, I'm going to die broke, but don't worry. You're going to get tax-free. You're going to my wife. Yeah, I said, you're
yeah.
going to get, why would I leave you a bunch of cash that the government can tax, even if I had a trust? No, it's a great way to go. Keep going. I'm sorry, I did interrupt, but yeah,
No, yeah, thanks for interrupting. Yeah, that was no, that's actually that's a big part of it is the
yeah,
taxes, right?
yeah,
And the policy grows, it grows tax free, the growth of it. And then in almost 90, I would say 95% of the situations we've worked on, the loans are tax free, the withdrawals are tax free, the it's entirely tax free. It's almost like a Roth IRA,
right.
how you would pay tax on the money going into it, and then after they grow tax free, and then you take the money out tax free. Very similar. So it's not completely like 100% tax free. You have to pay taxes on the money going into it, but once you put the money into it, it grows tax free loans, tax free withdrawals, tax free, like you said, tax free life insurance. Also, there's a lot of asset protection involved with life insurance policies. So in a lot of states, including my state, the state of Illinois, life insurance policies are an exempt asset. That means that, and I'm not an attorney, so don't hold me to this. Talk to your attorney
Right.
about this, but it's an exempt asset. It typically can be used in a lawsuit. It's not public information, right? Like if you own real estate, you own other assets, you have bank accounts that could potentially become public, right? Like lawyers can
Right.
get subpoenas and things like that, but life insurance policies are exempt from that. So, and depending on the state you live in, I know Florida's are like the best state probably in the country for asset protection and for these types of vehicles and financial instruments. But yeah, so taxes, asset protection, and then of course the volatility. So if we look at life insurance policies, let's just use a reference like from the year 1900 until now. There's been a consistent growth. Even if the growth is like, let's just say 2 or 3% in the cash value growth, that's significant over a 100-year period, right? And
Right.
there's never a down. It never goes down. I'm a big fan of real estate. I'm a real estate investor myself. I'll continue to invest in real estate, but even real estate has down years. If you look
Right.
at, for example, single family homes between 2008, I know it's a bad
Right.
number to use, but between 2008 and like
I don't
2000,
work on Wall Street anymore.
if we look at houses that were sold in 2008, and then I think about 2018, 2019, about 10 to 11 years later, they were sold for the same price. So there was like no growth at all during that time.
Right.
So whole life insurance is one of the only vehicles that has consistent growth regardless of market conditions. So that's kind of the reasons why, I use whole life insurance alongside other investments and why a lot of other clients use these types of vehicles alongside their investments.
my perception, and I used to be in the business of selling a lot of variable annuities. But there is a perception that variable annuities can have some counteractive measures that people don't like. Do you see this as your program as a better source of asset protection than, say, a variable annuity or something that does invest in the market, but is also an insurance at the same time?
Yeah, definitely. Good question. Yeah. So a variable annuity, it's one of them, I guess one of the downsides to it is just the fees, right? It's
Right.
like I'm doing like the certified financial planner program right now, the CFP program. And even in the CFP program, it mentions that variable annuities, if you're using them just for like cash growth, it's
Growth vehicles.
essentially, yeah, it's essentially an expensive mutual fund. That's what it,
It's what it is. It is exactly what it is. I mean, there's management fees up and down the line,
Yeah.
but they sell it, or I used to sell it as an option to invest in the market, but still be covered by the insurance blanket,
Yeah.
with
Yeah.
some guarantees. But in reality, that guarantee didn't mean a whole lot because you were paying 2 to 3%, chop off every year,
Yeah.
and they could guarantee 7. Well, all of a sudden it's 4%. If it was a bad year. And when I'm talking 2008, right? I mean,
Yeah.
2007, 2008, when the market, along with real estate, got chopped. So,
Yeah.
I think it is. I love whole life policies as an asset protection. So talk about a little bit, I guess, we talked about asset protection. We talked about, kind of what you can be involved with. You were talking about predictable growth a little bit. Can you expound on the predictable growth at all? Is there more to it that you can discuss now without giving away the secret sauce?
I mean, yeah, definitely. So like when we start a policy, right? So
Mhm.
like if, for example, somebody, let's just use even numbers, somebody's 40 years old, they want to do a 30-year whole life policy. They're gonna do $10,000 a year into the policy for the next 30 years. Every year they see their cash value, their projected outline, and then their death benefit grow. And there's consistent growth year after year, regardless of market conditions. And then sometimes people are like, well, how is that? How is it that if another market crash happens, how is it that the cash value in the policy or the life insurance won't be affected by that? And it really comes down to how insurance companies operate. So they operate based off of actual reserves they have, whereas a bank operates using, money that they technically don't have yet. They're borrowing fractional reserve banking. It's almost like, I don't want to say printing money, but it's almost like imaginary money, right? Which is a big flaw in the banking system.
Sure.
Whereas insurance companies are based off of actual reserves that they have. So if they have $50 million in life insurance death benefits out there, they have that in their reserves. They actually have to have at least 2 times that in reserves. And then also what they're investing into. So they're typically investing into about 60 to 80% into bonds, and then the other 20 to 40% in loans to real estate investors, to other banks, other insurance companies, to individuals. So they're super conservative investments, which helps them kind of outpace these or last in these recessions. And, even the Great Depression, insurance companies are still in business now from the Great Depression. Through the Great Depression. So that's really important for the client to understand, that you want your money parked somewhere that's gonna grow regardless of market conditions, and it's not going to be affected by those unexpected market churns. And then it comes down to the other question is, well, maybe I don't want to earn 2 or 3 or 4% a year. Maybe I want to earn 10 or 20% a year. And I'm with you on that. I do too.
More market centric returns,
Exactly.
Is that what people are kind of looking for? They're like, hey, I'd like to get something closer to market value than old CD values or money market rates, that people were getting 20 years ago.
Exactly. And it brings us to the next point, is that you can, a whole life policy, if it's structured properly, it's not like a either or scenario. You don't have to do this or real estate. You could do both. You could fund a life policy. Like I've done this myself. I've funded life policies before, borrowed against it, and then invested into real estate deals as a limited partner. So you could do certain things like that, and then you get the growth from those deals, the 16%, 18% internal rate of returns, whatever is projected. And then you have the base, your foundation is protected. You get 2-3% in there. So it could actually help you amplify the growth you're expecting from these deals. It can help you increase your rate of return. And that increase is tax-free. So it could help you cover some of the expenses you have later on down the road with that tax-free boost in your policy. And you get the asset protection and so on.
Yeah, this is going to drive you crazy what I'm about to tell you. I'm giving my age away a little bit. I love what you're doing, by the way. I really do. I think we need to spread the word a little bit more. But we used to do G&Ts, not gin and tonics, by the way. Growth and treasuries. So it would be like a REIT kind of, but it would be investing 50% of your dollars into the market, and then 50%. This is how high yields were then. 50% of your money into 7-year treasuries. So the worst case scenario, you could invest your money in the stock market. We call it a teddy bear trust. You would invest your money into the stock market and you would have guaranteed no losses, because over the 7 years of the treasury note, over that 7 years, your money would double. So half of your money would double back to the original investment. And then whatever the other half was invested in individual stocks, like you could have a tech G&T, and then that would grow in value. And so whatever was above that, so no matter what, 50% of your money would turn into 100% of your original investment, and the other half would grow as the market grew. So you could imagine, right, that because it's using the 7 to 8% compounded roll over 7 years doubles your money. So what would happen basically is you had no feasible way of losing your money whatsoever. That was good for about 2 years. And I swear to you, everyone loved it, and I would get hundreds of calls. Hey, when can I get another one of those growth and treasury deals where I don't have to worry about losing any money, but I can invest in the stock market and have unlimited upside? And by then treasuries were down to like 2%, right? It was like never again. Never. You just lived through one of the greatest times in interest rate and stock market history. This was like in 97, and it was, and we would charge 5% of the NAV just to get into it. And people would fight you for, there was only so much you could put in, right? And people would fight for it, man. It was crazy. But I do like what you're doing. So how would, I do notice, is the best way to get in touch with you, Sarry, is the thinklikeabank.com? Is that the best?
Just to be clear, it's thinkinglikeabank.com.
I'm sorry. I'm getting blind. I got to get a new set of glasses. Thinkinglikeabank.com. I apologize. And that is the name of the downloadable book as well.
Yeah, exactly. So you can find everything at Thinking Like a Bank. You can find my LinkedIn, YouTube channel, ebook. You can schedule an appointment with me. You can send me an email. All that is thinkinglikeabank.com.
And what can they expect, like when they get there? Like I've gone over, I did some due diligence on your site. So do they have some options, right? Download the ebook, and then if they want to talk to someone right away, they have that ability.
Yeah, definitely. You can schedule an appointment with me. There's a Calendly link there, a calendar booking link. You can schedule like a 15-minute call with me. If you have any questions, I'll be more than happy to work with you. You can download the book, send me an email. If you're really interested and you want to go further into, you can schedule the financial analysis meeting, because that's one of the major steps we do. So we have like the intro call first, and then we do a financial analysis to make sure that we understand your financial situation, we understand your goals, and then after that we would present a solution to you, detailing based off of our financial analysis, meaning what we think could be a good fit for you. And then after that, we would have like 6-month reviews. Every 6 months, we would it's an ongoing relationship. So something that we constantly, maintain and constantly talking to clients. Yeah, but the initial steps, intro call, if you want to schedule that, or a financial analysis meeting, I'll be more than happy to work with you to get to understand your financial goals. If you wanted to invest in real estate, if you wanted to invest in other investments using cash value whole life insurance, and kind of the pros and cons of doing so, I'll be more than happy to work with you on that.
Fantastic. Well, here we are, the last couple of minutes left in the show. And as I always do, I kind of let you take us out. Tell us whatever on your mind, your soul, your heart. It could be about thinking like a bank, or it could be about your family. Doesn't matter. Whatever you feel like you want to share with our audience here in the last couple of minutes.
Yeah. For the entrepreneurs out there, I'm an entrepreneur myself. I know it's difficult. It's a difficult space to be in. I've been an entrepreneur for 7 years, and kind of just, I work with clients all the time. And sometimes I go into like this, from financial, consultant to business coach, and I'm fine with it. I like business coaching as well. So,
Right.
I think there was a story I heard, and it was about a Chinese bamboo tree. And these trees, when you plant the seeds, you water it, right, for 5 years, and nothing happens. Like, you have to keep water, nothing happens. And then after 5 years, these trees grow like 90 feet a week for
Mhm.
5 weeks. So there's exponential growth, and you would think that the tree's never going to grow. So I like to use that same analogy with business, is that you're constantly watering your business, and sometimes it doesn't feel like it's going to grow. And again, I'm putting on my business coach hat right now, and
Right.
and it is growing. You just can't see it grow yet. And when it does grow, it's gonna be too much to handle.
That is a great analogy, sorry. It is a great analogy. And the only reason I say it's a great analogy is I used to grow bamboo in my backyard in
Oh,
Dallas. And let me tell you something. Don't let those seeds get out of hand, my friend, because they'll be all over your yard and you'll never be able to stop them. But that's a great analogy. It takes a while to plant the seeds and let it grow, but once it does, it's unstoppable. So I love it. I'm going to use it. I'm going to steal that from you.
yeah.
Sarry Ibrahim, thank you so much for being on the program. I look forward to catching up with you maybe over the next 3, 6, 9 months.
Yeah.
See how things are going. We have a lot in common, and I really enjoyed you being on the show today.
Me too, Tim.
Have,
Thanks for having me.
have a great week.
You too. Thanks.